Verizon just got kicked out of the Dow Jones. The stock is down almost 8% this month. So is this a falling knife or the buying opportunity of the year? Let's break it down. Verizon dropped roughly 7.8% this month, hit by two big headlines: getting removed from the Dow Jones Industrial Average, replaced by Alphabet, and a new joint venture with BT Group that's shaking up its balance sheet. Analysts still expect stronger earnings in 2026, but near-term sentiment is shaky because of restructuring charges and integration costs hitting next quarter. Let's look at both sides. First, the case for buying. Verizon just posted its strongest adjusted EPS growth since 2021, $1.28 in Q1 2026, beating expectations. Even bigger, it landed its first positive first-quarter postpaid phone net addition since 2013. That's huge for a company that struggled with subscriber losses for years. Management was confident enough to raise full-year EPS guidance to a range of about $4.95 to $4.99. Then there's capital allocation. Verizon announced a massive $25 billion share buyback, with at least $3 billion of that hitting in 2026. And the dividend? Management calls it ironclad, currently yielding around 6.2%, after 20 straight years of annual increases. That's a serious income play for long-term holders. On top of that, the company is actively cleaning up its debt, recently buying back about $1.86 billion in notes, trying to cut high-coupon debt and bring its leverage ratio down by late 2028. Now here's why the stock is under pressure. Verizon just revised its Q2 2026 forecast, and it's ugly. They're now expecting a net loss of $700 to $800 million, driven by asset reclassifications tied to that BT Group joint venture, plus severance charges of up to $450 million from ongoing layoffs. Then there's the index removal. Getting dropped from the Dow and replaced by Alphabet triggered heavy selling as index funds rebalanced out of the stock. Technically, it's now trading below its 50-day moving average, a warning sign for momentum traders. And longer term, competition isn't going away. Even with positive subscriber numbers right now, analysts are watching churn risk closely in a crowded market, especially with potential new entrants like Starlink. Verizon's fiber build-out is also lagging behind key competitors, raising questions about how much capital they'll need to spend just to keep up. So where does that leave us? On one hand, improving fundamentals, a raised guidance, a massive buyback, and a 6% plus dividend. On the other, a near-term earnings loss, technical weakness, and long-term competitive pressure. This is a classic value versus value trap debate. If you're an income investor who can stomach short-term noise, the dividend and buyback story is compelling. If you're focused on momentum and near-term catalysts, the next quarter could be rough. Let me know in the comments. Are you buying this dip or staying away? Drop a like if this breakdown helped, and subscribe for more stock deep dives every week. Disclaimer: this video is for informational purposes only and is not financial advice.